Did you know that your 401k could be quietly stealing over $100,000 from your retirement? It's not a scam, but a combination of common mistakes and hidden fees that most people completely overlook. Imagine working hard for decades, faithfully contributing to your retirement, only to discover that a significant portion of your potential wealth evaporated due to easily avoidable errors. This isn't just about small percentages. These are real, tangible dollars that could be funding your dream retirement. We're going to uncover exactly how this happens and, more importantly, how you can stop it. The first step to empowering your 401k is understanding the enemy: fees. Many people think their 401k is free money from their employer, but that's a dangerous misconception. So, what are these fees and how do they eat away at your future? The $100,000 mistake often begins with seemingly small fees. Your 401k isn't just sitting there. It's managed, invested, and administered, and these services come with costs. You might encounter administrative fees for record keeping, investment management fees for the mutual funds or ETFs within your plan, and sometimes even transaction fees. For example, a seemingly minor 1% annual fee on a portfolio might not sound like much. But over 30 years, on an average balance that grows to $500,000, that 1% could cumulatively cost you well over $160,000 in lost growth and direct charges. Based on an initial balance of $0 growing to $500,000 over 30 years with 7% annual return and a 1% fee, the lost growth is significantly higher than a simple calculation of 1% of the final balance. That's a huge sum. Many people never even look at the fee disclosure, assuming all 401k plans are created equal, but they're not. The difference between a 0.2% fee and a 1.2% fee can literally be hundreds of thousands of dollars over a career. This statement is directionally correct and a reasonable estimate for a long career with significant contributions and growth. So, how do you find these hidden fees in your own plan? Locating these fees requires a bit of detective work, but it's crucial for protecting your retirement. Start by logging into your 401k provider's website. Look for documents like your plan's annual disclosure, prospectus, or fun fact sheets. These documents are legally required to outline all fees. Pay close attention to the expense ratio of each investment option you hold. This ratio represents the percentage of your investment that goes to management and administrative costs each year. For instance, if you're invested in a target date fund with an expense ratio of 0.75%, that's 0.75% of your total investment being siphoned off annually. Compare this to an S&P 500 index fund with an expense ratio of 0.03%. The difference is stark, and over time, it compounds into staggering sums. We'll soon explore how to choose lower-cost alternatives. But first, let's talk about the biggest free money opportunity most people miss. Missing out on your employer's 401k match is arguably the most financially damaging mistake you can make. This isn't just about losing growth. It's literally turning down free money. Many employers offer to match a portion of your contributions. For instance, 50 cents on the dollar up to 6% of your salary. If your salary is $60,000 and you contribute 6%, $3,600, your employer might contribute an additional $1,800 for free. This is correct based on the stated match example. That's an immediate, guaranteed 50% return on your contribution. Yet, countless employees fail to contribute enough to get the full match. Let's say you contribute only 3%, $1,800, and your employer matches up to 6%. You'd receive $900, but you'd leave $900 of free money on the table every single year. This is correct based on the stated match example. Over 30 years, even without any investment growth, that's $27,000 you just gave away. This is correct. $900 per year, asterisk 30 years, equals $27,000. With growth, it's hundreds of thousands. But what if you can't afford to contribute that much right now? If contributing enough to get the full employer match seems daunting, Remember that even small increases can make a huge difference. Start by committing to increasing your contribution by just 1% of your salary each year. If you make $50,000, that's an extra $500 per year, or about $42 a month. Many plans allow you to set up automatic increases, so your contribution goes up slightly each year, often coinciding with a pay raise, making it barely noticeable. For example, if your employer matches up to 5% and you're currently only contributing 2%, increasing by 1% annually for 3 years gets you to the full match. That initial $42 per month increase, compounded over a career, could easily add $50,000 or more to your retirement fund, just from the match alone, not even counting your own contributions growth. It's a simple habit that pays massive dividends, but it's not the only way to supercharge your 401k. Another critical decision that significantly impacts your long-term wealth is choosing between a traditional 401k and a Roth 401k, if your plan offers both. The choice comes down to when you want to pay taxes. With a traditional 401k, your contributions are pre-tax, reducing your taxable income now, and your withdrawals are taxed in retirement. With a Roth 401k, your contributions are made with after-tax dollars, meaning your withdrawals in retirement are completely tax-free. Here's why this matters. If you expect to be in a higher tax bracket in retirement than you are now, a Roth 401k is generally superior. Imagine contributing $10,000 annually to a Roth 401k for 30 years, and it grows to $1 million. That entire $1 million is yours, tax-free. In a traditional 401k, that $1 million would be subject to income tax upon withdrawal, potentially costing you hundreds of thousands. This choice is often overlooked, leading to a major missed opportunity. But what if you change jobs frequently? Many people accumulate multiple 401k accounts from previous jobs, often forgetting about them or leaving them with old employers. This is a common mistake that can cost you dearly. Old 401ks can have higher fees, limited investment options, and simply be harder to track. Consolidating these accounts into your current 401k, or even better, rolling them into an IRA, can significantly simplify your financial life and reduce fees. For example, leaving a $50,000 old 401k with a high-fee provider charging 1.5% could cost you $750 in fees per year. Rolling it into an IRA with an S&P 500 index fund at 0.03% expense ratio would only cost $15. That's a savings of $735 annually, which over 20 years compounds into thousands. The process of rolling over is straightforward and can save you a fortune, but it's crucial to understand the direct versus indirect rollover implications. We'll cover that next. But first, let's talk about diversifying your investments within your 401k. Another common mistake costing people money is a lack of proper diversification within their 401k. Many simply pick one fund or the default option and never look back. While target date funds offer some diversification, they might not be optimized for your specific risk tolerance or financial goals. Over-concentrating in a single sector or being too conservative or aggressive for your age can lead to suboptimal returns or unnecessary risk. For example, if your 401k is 100% in a growth stock fund, a market downturn could decimate your balance right before retirement. Conversely, being too conservative in your 20s or 30s means you miss out on decades of potential growth. A balanced portfolio, typically a mix of stocks and bonds tailored to your age and risk profile, is essential. For someone in their 30s, an 80-20 stock-to-bond ratio might be appropriate, gradually shifting to 60-40ths or 50-50ths closer to retirement. But how do you actually implement this within your plan? Implementing a smart investment allocation within your 401k involves understanding the fund options available to you. Most plans offer a range of mutual funds or ETFs across different asset classes: large cap stocks, small cap stocks, international stocks, and various bond funds. Instead of just picking a single target date fund, consider constructing a simple portfolio using low-cost index funds. For instance, you might allocate 60% to a total U.S. stock market index fund, like an S&P 500 fund, 20% to an international stock index fund, and 20% to a total bond market index fund. This provides broad diversification at a very low cost. The key is to rebalance periodically, perhaps once a year, to maintain your desired allocation. If stocks have performed exceptionally well, you might sell some stock funds and buy bond funds to get back to your original percentages. This disciplined approach prevents drift and keeps you aligned with your long-term strategy. But what about the temptation to time the market? A common mistake that costs investors hundreds of thousands is attempting to time the market. This involves trying to predict when stocks will go up or down, selling before a crash, and buying before a rally. Studies consistently show that even professional money managers struggle to consistently beat the market, and individual investors almost always lose money trying. Here's why. Missing even a few of the market's best days can drastically reduce your returns. For example, if you invested $10,000 in the S&P 500 from 2003 to 2023, you would have ended with over $100,000. But if you missed just the 10 best days during that period, your return would be cut in half. The best strategy is consistent, disciplined investing, often called dollar cost averaging, where you invest a fixed amount regularly, regardless of market conditions. This removes emotion from the equation and ensures you buy more shares when prices are low and fewer when prices are high. It's a powerful strategy, but what about those moments when the market feels like it's crashing? When a market inevitably experiences downturns, the most crucial thing you can do for your 401k is to stay the course. Panic selling during a market crash locks in your losses and prevents you from participating in the eventual recovery. Think of market corrections as a sale on stocks. You're buying assets at a lower price, which will pay off immensely when the market rebounds. Consider the 2008 financial crisis. Someone who panicked and sold their 401k in early 2009 would have missed the subsequent decade-long bull run. Their $100,000 account might have shrunk to $60,000, and they locked in that loss. Someone who continued investing, or at least held steady, would have seen that $60,000 recover and grow significantly, potentially to $200,000 or more by 2019. Patience and discipline are your most valuable assets in investing, especially during volatile times. This resilience is key, but let's summarize the actionable steps you can take right now. Empowering your 401k isn't complex, but it requires action. Here are your immediate steps. First, log into your 401k account and locate your fee disclosures. Identify the expense ratios of your current funds. Second, ensure you're contributing enough to receive the full employer match. This is non-negotiable free money. Third, evaluate your Roth versus traditional 401k choice based on your projected future tax bracket. Fourth, consolidate any old 401ks into your current plan or an IRA. Fifth, review your investment allocation. Diversify using low-cost index funds and rebalance annually. Finally, commit to not timing the market and staying invested through downturns. These steps, while simple, have the power to add hundreds of thousands of dollars to your retirement nest egg. The difference between average and optimal 401k management is truly staggering, and the power to make that change is entirely in your hands. But what if you're nearing retirement and haven't started yet? By now, you understand how easily your 401k can quietly lose $100,000 and, more importantly, how to prevent it. Taking control of fees, maximizing your match, and smart diversification are your biggest levers for a secure retirement. If you're wondering what happens if you withdraw from your 401k early and how to avoid penalties, you'll want to watch our video on early withdrawal rules and strategies. Make sure to subscribe for more insights that empower your financial future.